So here's where we go through, again, the summary of what is happening on the refined product side. That white line is the 2022. So you can see that we're now just below or just right at where we were in 2017, just below where, or just above where we were in 2020. But you can see that we normally get that rally. So you normally start to see those increases because we're coming into spring, you're coming into spring break, you're coming into vacation. So we normally see that bump. The problem, which is what we've been talking about, is that we expect this to go and again, rally high, like go higher, but stay just below where those averages are, because you can see that they converge on the average front. Now, that's something that we do expect this to go back up, but we'll talk about some of the different pieces as we go through the on the gasoline side. Now, obviously, diesel is also a part of this. When you look at heating oil, it's going to come down to how warm is March, how warm is April. If that's much warmer, because if for those that have own a home, that your heat can click on at different times in the night, and the question will be where does that heating oil demand remain, because diesel is going to remain strong. We don't see that changing in terms of road diesel, so that's going to be one that's going to be elevated, and we continue to see jet fuel staying fairly flattish. Again, underperforming a bit more than gasoline. We expect gasoline to have a stronger rally along seasonal trends, but it's something that jet fuel is going to be a bit of an overhang, and it's really because of price. It's because of just, I'm not sure how excited people are to travel abroad given what is happening in the around the world today. But again, these are some of those different pieces that we'll continue to talk about. Now, when we look at distillate had that draw of 570,000 barrels. That's 27.2 below the 5-year average. And again, it was driven, the drop was driven by Pad 2 and Pad 1. And then Pad 3 had the build of 1.09 million. So that's something that we expect Pad 3 to continue to see a bit of those builds. Pad 1's going to waffle back and forth depending on where heating demand is. So the imports remained elevated. They increased, even though they declined by 13,000 barrels a day. That's still 158,000 above the 5-year average. But to be clear, we've been importing a decent amount of Russian diesel. So now, to be clear, anything that was already scheduled, we expect to be delivered, because, again, there aren't sanctions. So we do expect that to show up and be delivered. They may try to get it there as quickly as possible, or they may try to sell it while they still can, but we won't see any new loadings. And that's the difference in terms of what is already sailing and what is scheduled to be loaded. And the schedule to be loaded is just not there. So one of the things that headline that just came across right now, U.S. to impose export controls targeting Russia oil refining. And again, that's going to be one of what we're talking about here, because a lot of this diesel has been showing up in Pad 1. And the question is going to be, how do we replace it? If it was me and I was making decisions, which we know I'm not, it would be to alleviate and get rid of the Jones Act, or at least pause it for a time period, which then would allow a transfer from Pad 3 to Pad 1, not only through the Colonial Pipeline, but also by boat. But, as we all know, politicians don't like to be rational. So now when we look at where diesel demand is, here you can see it's at seasonally adjusted highs. We're just going to continue to be at these elevated levels, well above the 5-year average. It'll come down a bit just because things have gotten a bit warmer, but it's still going to be that the backbone will remain diesel, and more specifically road diesel. And here's what we're talking about, as we were saying, again, just staying elevated in market demand, that 165 to 180, it's just going to stay very firm in this level. It likely won't go to the top of the range as we've seen, but it's still going to stay, as you can see, at a very high level. Load availability still near record highs as we continue to see those demand levels. When you look at rail traffic, car loads remain elevated. It's going to be, again, some of this is skewed just based on what week we're in and what last year showed. So here you can see that we're still up on a lot of these different pieces. Coal's going to remain a very big winner here, especially as coal prices have surged. Chemicals, something similar, just because chemical movement was so low last year. And then grains, forest products will remain strong. Motor vehicles, still, we're already seeing more issues on chips and other types of the equipment. Petroleum products, same thing. The biggest one's going to be intermodal. You can see intermodal still down versus last year. That's where they have not been able to get themselves kind of righted in terms of where they can move some of these car loads and trying to take some of this take back some of this market share that with a lot of it going into the trucking route, which is something that we've been talking about what feels like a very long time at this juncture. So when we look at what is coming into the U.S., you can see that we're starting to get an increase in what is coming through. A lot of that is, so there's two pieces to this. One, you had Lunar New Year in China, so you differ about let's call it 7 to 10 day period. You had much lower exports. And then at the same time, you have a new tidal wave of product coming into the U.S., but it is more than 40 nautical miles off of the coast. So again, this is where we're still seeing it. It's still there. And you'll start to see that show up, which will take that March 13th to March 19th, that week 11. That'll take it much closer to where we were last year. As you can see, where we're starting to continue to see those increases. But they really won't start to ramp up until we get into March, further into March. Here's what we were talking about with demand. So heating oil demand is the highest in New England. This is just showing that you're going to see a decent amount of demand for also natural gas, just given where some of the natural gas usage is on some of the areas that are going to see some of that below temperature. The Northeast is going to be a bit warmer. Again, warmer versus average, so it's still going to be in the 40s and 50s. So it's just, you'll still use heating oil, you'll still use natural gas, just not as much. And that's something that is going to be a benefit, or at least put additional crude or distillate into storage. And just to break it down, it's essentially following the Mississippi River. Anything east of the Mississippi River, much warmer than normal. Anything west of the Mississippi River is going to be much cooler. So now when we look at gasoline, you can see gasoline had a drop of 470,000 barrels. That's 9.2 million below the 5-year average. But one of the things is that flat line, where typically we start to see that roll over, as you can see in terms of the top of the cloud. Imports slightly up. They were up 186,000 barrels a day. That's something that was really driven more by PADD 5, as we do expect to see this come back down. That's 140,000 barrels above the 5-year average. We expect to see that come much closer to about 400,000 barrels a day as we go into next week, as we were talking about with what was loaded, because there's always that timing delay, and we do have some additional coming from Asia that's coming into PADD 5, so that's going to be something to watch as well. Blending components had a small drop of 560,000 barrels. That's only 1 million below the 5-year average, and we'll show in a minute why it's kind of coming into that congestion, and we expect that to remain elevated, especially as problems are continue to remain on the petchem side, but we'll talk about that in a minute. Now, when you look at China, there was a nice strong bounce following Lunar New Year. People getting back to work. There's also been more talk on getting rid of the zero tolerance. So that's something that would be a benefit for where activity is. But again, that's something that we're going to have to continue to follow. Google motility as a whole, when you look at Asia Pacific, world, Americas, Europe, rolled over a bit. Again, you had that spike in parts because of things getting a bit back to normal. In other parts of Asia, you had some vacation time. So again, you're just kind of bumping along what is normal with Apple mobility, again, continuing to move up a bit, but we'll get a bit more strategic on what does that mean as Google continues to kind of moderate and go sideways. Now, when we look at U.S. gasoline, you can see, according to Gas Buddy data, gasoline demand rose for the third straight week, up 1.4% from the prior week and 6.1% above the 4-week rolling average. Again, still staying strong. You had a strong closeout to the week, and now you're starting to see some of that roll over a bit in terms of this week, and not by a lot. I'm just talking about in terms of the 4-week rolling average, because you had two really strong weeks. Now you're getting that just rolling back a bit, and you're just going to see that peak and things just coming off just a bit, but still staying elevated in general, but again, just moderating a touch. And this isn't helping. When you look at what we've seen so far in terms of gasoline prices went up another $7 and a half and 0.8 cents. I'm sorry, 7.8 cents. And when you look at that, now takes us at a average of $3.608. So we're going to be over right now, especially based on Brent, because gasoline typically prices off of Brent, which is the last incremental barrel. So we're heading well over $3.75. And now the problem is going to be as we get further and further along, as we get closer towards, again, people driving more, people moving about more, then we start getting towards summer grade. I mean, that's usually good for anywhere between 10 to 15 cents, depending on what the cost of naphtha is, what the cost of blending components are. But that shift is going to, again, send us into another stratosphere, which is why that RVP conversation is happening now. But again, we expect to see another 7 to 10 cents increase over the next few days. It's already happened. So I'm saying that knowing that we've already seen an increase. So essentially, by the next time we speak, we'll be up another 5 cents from where we are here. Diesel's the biggest problem. It's up another 5 cents, comes in at 4.104, so just over $4.10. And remember, that hits every single piece of your life, which is why that is the biggest problem when you look at inflation. You had Powell coming out saying that which is the big if, inflation stays elevated, then we should see a rate hike, which again, we continue to expect to see a rate hike, and we continue to see these prices just ratchet much, much higher. When you look at blending components, again, back to the gasoline comment, you can see that we're just flatlining here, coming into some congestion. We continue to see that, and we'll continue to see that stay fairly elevated and right in line with the 5-year average. And as we showed in the first segment, you can see that on the gasoline demand side, we're just above where we were in 2017. And then you normally get this pivot up. One of the things is we're going to get that pivot. It's just we're saying that it's going to be a little bit on the shallower side, and it'll fall outside what is normal. And that's going to be just something that we're going to see, given the 5-year average was skewed because of Uri, because if you can see where that big drop is from last year. That's something that if you take that out, we're still fairly below where we were on a 5-year average. Now, when you look at the number of, again, looking at Google, the breakdown, you had workplaces coming down a bit. Again, you had some of that vacation time. You had residential increasing a bit. Again, the workplaces is still fairly off what is normal. This comes into what we're expecting with the normal period of just lower demand because of more work from home, just more flexible schedules, and we're continuing to see that, again, continue. Apple trends, you can see that's routing requests. Again, requests, not actual movements. That's the key difference between Google and Apple, which is why we do like the Apple stuff a bit better, but it's still good to look at. You're still seeing that things are fairly elevated and remain elevated and still above where we were in last year, but fairly in line with where we were in peak driving period. So again, more support for a bit more of a normal atmosphere going forward. Propane had a small draw of 850,000 barrels. That's 11.8 million below the 5-year average and the lowest ever. That's, again, continuing to be more of a concern, especially as we remain at a very low level on days of supply. Days of supply is now below 20, which is that, I don't want to say a crisis level, but an area that is of a greater concern, especially as you get down to those levels. We're starting to flatline, but again, that's going to be a level of how quickly do we get back to normal, because heating demand has come down a bit. It's still elevated in other areas. So as you see this, coming lower, that's where you start to see, is there going to be a gate on exports? We won't. I'm not saying we will, but this is something that it becomes a much bigger issue when we look at where some of the flows are and what that could look like. Now, on the jet fuel demand side, you can see that we had a build of 340,000 barrels. That's 4.8 million below the 5-year average. But when you look at that level in general, you can see that we've gone fairly flat. We do expect this to go up next week, but the question is, we just don't see it's going up as normal as it normally does, because you can see that if every single year you get a spike next week, and we're just saying that we're going to get a spike, it just won't be as big as the others, and again keeping us below what is seasonally normal. And here's one of those confidence levels of, we're still getting those lower highs, those lower lows, as we still fall off of what is normal. And you at this point, for another week or two, you can still use 2020 as quote unquote normal. And then 2019, obviously. So we expect to see this remain. But again, as we said last week, in the week before and the week before that, we were going to see an increase along seasonal norms. It's just going to be at a slightly less level. And then we see that continuing through. Global departures scheduled for the 12 weeks ahead is 0.5% lower week on week. Again, things are fairly flat, and we don't see that adjusting, keeping things fairly limited. Now, on the restaurant side, things have gotten better. You can see that we're now almost 11% on average, 10 to 11% above normal on the weekends, and then about 2 to 3% above normal on the weekdays. We expect that to be the case where going forward, on the weekends, we expect to be about that 10% above normal. On the weekdays, we expect to be anywhere between negative 5% to positive 5%, depending on the weather. And that, again, is showing a bit more of a recovery in activity. The question will be, when do prices start to slow people down from eating out? But those are things that we're going to discuss more in the economy show. Now, in the next segment, we're going to go a bit more abroad and look at what is happening on a global footprint, especially with what is happening in Russia. Russia and Ukraine.